Welcome to Factful Finance, where we break down complex finance concepts into simple, actionable advice. Have you ever wondered why your financial advisor talks about stocks and bonds as if they're the same thing? Let's clear the air today. While both stocks and bonds are investment vehicles, they serve different purposes and come with distinct risks and rewards. Understanding these differences is crucial to building a solid investment strategy. Let's start with stocks. When you buy stocks, you're purchasing a small ownership stake in a company. This means if the company grows and becomes more profitable, the value of your stock can increase, allowing you to sell it for a profit. However, if the company performs poorly, the value of your stock can drop, and you could lose money. It's like buying a piece of a business. If the business succeeds, so do you. But if it fails, you're in trouble. Now let's talk about bonds. When you buy a bond, you're essentially lending money to a company or government. In return, they promise to pay you interest over time and repay the principal amount at the bond's maturity. Bonds are generally seen as safer than stocks because they provide more predictable returns. However, the trade-off is that they typically offer lower returns compared to stocks. Think of bonds as lending to a friend who promises to pay you back with interest. Safer, but less exciting. Both assets are critical in portfolio diversification, which is a strategy to spread out risk. By holding both stocks and bonds, you balance growth potential with stability. For example, imagine Sarah, a 35-year-old investor with a goal to retire at 65. By holding a mix of stocks for growth and bonds for stability, she reduces the risk of losing everything if one part of the market crashes. The difference between stocks and bonds boils down to risk and return. Stocks offer high potential rewards but come with high risk, while bonds provide steady income with lower risk. Quick disclaimer: the information shared in this video is for educational purposes only. For personalized advice tailored to your unique financial situation, please consult a licensed professional. Let's talk numbers. As of recent trends, stocks, historically, have an average annual return of around 10%, while bonds typically return around 3 to 4%. But remember, stocks can fluctuate wildly in the short term, while bonds are more predictable. What about in practice? Take the 2008 financial crisis. Investors who held stocks during that period saw massive losses. On the other hand, bondholders, especially those invested in government bonds, saw much less volatility, highlighting how bonds can serve as a safeguard when the stock market stumbles. Here's a tool that can help you figure out how much you should invest in stocks versus bonds. The rule of 100. Subtract your age from 100, and the result is the percentage of your portfolio that should be in stocks. For example, if you're 30 years old, 70% of your portfolio should be in stocks, and the rest in bonds. This strategy can help you manage risk as you age and move closer to retirement. To sum it up, stocks and bonds are both integral to any investment strategy, but they serve different purposes. Stocks are for those looking to grow wealth quickly, while bonds are for those seeking stability and regular income. The key is finding the right balance for your goals. What's your next step? Are you considering adding bonds to your portfolio, or is your focus on growing wealth with stocks? Let us know in the comments below. Thanks for watching Factful Finance. If you found this video helpful, give us a thumbs up, hit that subscribe button, and turn on notifications for more expert insights on personal finance. We'll see you in the next video.